I hope you're all doing well today and you're feeling well rested, having enjoyed some well-earned time off with family and friends. My name's Jordan Kent and I'm a business development manager for Blackfinch Asset Management. And today I'm joined by Josh Clayton, Blackfinch Group's product specialist for listed investment solutions. Today's session, we'll be covering what we feel are three key areas of focus at present. First is French politics. Coincidentally, there have been further goings on the day following the December 2024's forecast. So, in essence, we'll be picking up where we left off there by considering what everything that's happening in France means the direction of the economy. Second is German politics. Essentially, Josh will be exploring here the signs we're seeing come out from Germany, which are echoes of what's actually occurring in France. And thirdly, are two critical points from the USA, namely that of the inauguration of President-elect Donald Trump and also the actions of the Fed. So with the scene set, Josh, I think it's best I hand over to you. Josh, good morning.
Good morning, Jordan, and good morning, everyone. A very happy new year from me and the investment team here at Blackfinch. He's already set the scene here, so I'm going to start off with France and the wider Eurozone and then go on to that all-important event over the Atlantic. So firstly, France. Now, the government had fell apart the day after my previous webinar and their Prime Minister, Michel Barnier, was dismissed. Now, this has never happened so fast within the 66-year history of the government. And as a very brief recap, President Macron appointed Michel Barnier in September, and he spent 3 months trying to come up with a 2025 budget that's going to gain a majority in Parliament and reel in France's worryingly indebted finances. The economy has some big economic challenges. That's from rising public debt, slow growth, and the need for major pension and energy reform. So he tried to push through this budget with a vote in the lower house of Parliament, which infuriated lawmakers on both the right and the left. And as a result, France's far-right party and its left-wing alliance each put forward no confidence motions. And with the Parliament being split three ways, the chances of any decisive changes to policy in any direction are quite difficult to say. We may see some drift over the coming months through 2025. So where does this leave the economy? Is it still underperforming the wider Eurozone and some other developed peers? Well, there can't be any elections, at least until the summer, and Macron's mandate lasts until 2027, so it's hard to see a positive solution. A problem for the country and other core European countries are growth expectations. And it doesn't really paint the best picture. But importantly, what we need to do is think about central banks. The ECB is forecasted to cut 4 times this year, and the Fed has only penciled in about 1.5 to 2 cuts in the US. So if that is the case, that would naturally undermine the euro, so watching these two currencies is going to be really crucial for the prospects of the Eurozone stock market. Can it make a recovery throughout 2025? Can it narrow that gap to the US? The other country to discuss today is Germany, and it still remains the largest economy in the Eurozone. And one of the key dates for us to look out for is the 23rd of February. So it's next month rather than January. But this is where Germany votes a new chancellor in to replace Olaf Scholz, who I discussed a fair few webinars back. But in short, we are seeing, as Jordan said, some faint echoes of France last year, where there could be a bit of a weak coalition and suddenly pushing through policies becomes quite difficult and you can get this gridlock. The economy currently has a debt brake that has stopped Germany borrowing to invest back into the economy. So the outcome of the election is going to be important for the wider Eurozone. And we can see collectively there's a difficult road ahead, and taking somewhat of an active investment style is going to help an investor and navigate some of these pitfalls where they have some analysts on the ground talking to these companies to understand the state of play for each respective economy. But more importantly, if we move over to the US, and I know this is the hot topic for the month, we're going to see the inauguration of President-elect Donald Trump. And that's on the 20th of January. And I stated in the last webinar that this carries the likelihood of new policies coming in quite quickly into his term. I don't want to dwell on Trump too much. He's been the main focus of this webinar over the last few months, but it's very important to understand some of the near-term and the longer-term dynamics that could be in play. Before we dig into the weeds, I do want to put a big caveat on this because I don't really think anybody truly knows what could happen, as Trump's really known to shoot from the hip. with these policies, but we are starting to see some consensus. So for the more near term, it's worth noting that economists and businesses are expecting tariffs to be announced early in Trump's second term. Now, we don't know specifics on scale, and although they won't go into effect immediately, we're already seeing some firms take early action as a result. And that's like front loading imports ahead of the tariffs to avoid those potentially higher costs. So this may mean that we could see a more immediate improvement in GDP figures for the US. So absolutely one to watch out for on a rolling basis as we're checking those GDP figures come in. But the wider question, of course, is what's going to be the longer term impact of these tariffs and when they come in, or if they come into force? Could this be contractionary for GDP figures as well as be inflationary for the economy? And this is what markets are digesting at the moment. It's likely to be one of the main factors for investment returns this year. And it's something ourselves in the investment team at Blackfinch are closely watching and trying to understand as this develops. If we stay in the US, but flip back to just before Christmas, we had the Federal Open Market Committee meeting on the Wednesday, the 18th of December. And every once in a while, things go as expected. The FOMC did exactly that by announcing that widely telegraphed interest rate cuts. And that marked 100 basis points worth of cuts over the last 3 meetings of 2024. So although the cut was widely expected, it actually turned into one of the biggest Fed-induced shocks in years. If you look at the 10-year Treasury issued by the Fed, you'll see the yield hadn't leapt as much to a response from the Fed or announcement from the Fed since the infamous taper tantrum all the way back in 2013. So that brutal response was felt throughout markets. Risk assets retreated when the news came out from Fed Chair Jerome Powell at his press conference. Volatility shot upward, and you can see that in the VIX index if you look on any recognized platform. And we also saw some pretty severe pressure on emerging market currencies. So what on earth happened that caused such volatility in markets? And like in the past, it comes down to interest rate sensitivity, rhetoric from central banks, and that interest rate cut expectation. An easy way to figure out the problem is by reviewing what's known as the dot plot. So that's just the survey of economic projections where each FOMC member offers predictions marked with a dot. So that's the potential increase in expected inflation and in projected economic growth. And it showed that almost all members scaled back on where they expect the Fed funds rate to be at the end of each year for the next 3 years. And if we look at averages, the midpoint for the Fed funds rate goes from 4.375 to 3.84-ish over the next year. So that's roughly 2 cuts. Investors were hoping for a lot more, 3 cuts or more, not 2. So factoring all of this in, I think it's fair to say that the 2024 rally in stocks was relatively overheated and was long overdue some kind of correction or profit-taking exercise. And that's what we saw in December. So why the shift in projections? Was it that committee members were doing this because they didn't like what they saw with unemployment or inflation numbers? Or is it the scare from the Trump 2.0 agenda bringing inflationary concerns back on the cards? We won't know for sure. We don't have an inside man or woman at the Fed. But any move that dramatic suggests maybe the Fed's communication was slightly off at some point, whether they were too positive in the past or negative now. But with that market rally we've seen in 2024, I do think it's fair to say investors were looking for any excuse to cash in on profits and trim their portfolios, and they were happy to use that as the catalyst. But going forward, we really need to pay attention on central bank rhetoric and decisioning, even more so than in the past when inflation was quite high. And to finish on the US and just talk more about the outlook for 2025, I think many investors are sat with sizable gains in their pot from US stocks and are wondering whether to cash in. If you go to Wall Street analysts, you'll actually see that there's a consensus for continued growth in the US. But the question remains is how are we going to navigate it? And I think that really there's 2 questions here. The first is consider inflation. If we see another 6 months of low 2% inflation, then the grass looks very green. We could see equities climb higher. But as I've said, the Fed are much more cautious on this. His hawkish cut is just an ample reminder that if we see a rate hike, then it will almost certainly mean lower share prices and an even stronger dollar from where it is. The second question is Trump 2.0, and that's going to be answered much more quickly on the 20th of Jan. We should know how aggressive he's prepared to be on tariffs, tax cuts, immigration, and these are going to be some of the key catalysts from his side of the pond. So if you do have clients asking about where markets could go, obviously there's no crystal ball, but you can just say that it's technically going to be Donald Trump's policies versus the Fed's policies. So these two are likely to be the factors that could drive markets and battle it out. Is Trump going to push through his America First pro-tax deregulation policies, or will the Fed react more strongly as a result and have a much tighter belt when it comes to interest rate control? I've slightly gone over, Jordan, but that's everything from me. So back to you for the record. Thanks, everyone.
Cheers, Josh. And thank you, obviously, everyone, for joining us today. Really hope you found that insightful. You can move forward equipped with details, able to help your clients. Now, if you've got any questions on the topics that Josh has covered today, perhaps there's some points we haven't covered you'd like to hear our opinion on, or if you're interested in hearing more about the Blackfinch Asset Management Solution Suite, then naturally we'd love to hear from you. You can reach out to us directly using the email address bfamsales@blackfinch.com, or you can call me directly on 01452 717 769. But for now, what I'd like to do is wish you a great day, and we'll hope to see you again next month for the installment of the 10-minute market forecast, which will be on Tuesday, the 4th of February. But take care for now.